Hello. The big feature of CapitaLand's 2014 annual report is retail. It's been an important part of the business for some time, but there is a lot more focus on retail now, and in the next couple of minutes, you'll hear me say that word over and over again. Retail. There it is again. And the reason is that CapitaLand has now restructured its portfolio, and we see that here in the org chart, where retail plays an important part. Yes, we've got CapitaLand Singapore and the CapitaLand China portfolio, which makes up about 22% of their earnings. But there's Capita Malls Asia, and they house both Capita Mall Trust in Singapore as well as the trusts in China and Malaysia. So retail, one of the four important business units now, Ascot being the fourth one. And when we look at where their revenue is coming from, we just have to look at page 60 to see the impact of retail on the portfolio. What we see here in this particular, these two ring charts, is on the right-hand side is last year's breakdown by strategic business unit. And the only difference that you'll probably notice between that one from 2013 and the 2014 chart there on the left is the expansion of the purple part, and that is retail, because retail has really grown quite substantially in terms of its contribution to revenue to the total group. And when we go down by geography, that's also an important aspect. Singapore there in light blue still making up the lion's share, just over half, 54.7% of revenue to be precise. Europe, by the way, makes up 9%, but in terms of earnings before interest and tax, EBIT, Europe is actually a much smaller sliver. Read the annual report for yourself and you can see that chart if you're interested in the European operations. Revenue by business type, and again that blue ring in this case refers to the trading of properties as opposed to fee income there in purple and rental income in green. So again what we're seeing is that the construction and sale of properties is still the dominant part of the business. Turn back in your copy of the annual report to page 4 and 5 and you'll see these charts here. Let me take you through just a couple of the important ones. Firstly, revenue. We can see that there in the right bar, almost at $4 billion and surpassing certainly the previous 5 years. Now that number is going to be important, $4 billion. Keep that number in mind because I'll come back to it. The profit attributable to shareholders is there at 1.16 billion, which has surpassed the 2011 year. We're still not quite back at the 2010 number, but certainly have ridden out the trough that we saw in previous years. And here is the net tangible asset value number, because this is important for shareholders. This is not what the price of your shares are, but what the value of your shares are if you were to take just the net tangible assets, and there it is at $3.83 per share. Where those assets are, you can find also on that page. The balance sheet, you can see in this breakdown, has gone from, in terms of investment properties, that's gone from 4 billion to 17 billion. So a very big growth in the amount of assets. We've also seen a sizable jump in development properties for sale from 5.6 to 7.6 billion. And where do they get the money in order to build and buy and trade these properties? The answer is obviously cash. And so, predictably, we've seen a decline in cash down from 7.2 billion to 2.7 billion, although they do also point out that they have quite a lot. I think it's about $5 billion worth of undrawn bank facilities. So certainly cash does not seem to be an issue. The cash flow from operations is at about 1 billion, up from 950 million last year. And the future looks bright, they say, looking at the statement from the Chairman and Chief Executive. 50 development projects in the pipeline worth, is that number right? $35 billion over the next few years. 35 billion. Do you remember just now when we looked at the revenue number and it was 4 billion? So if you just divide 4 billion into $35 billion worth of properties over the next few years, you can see that they have about 8 or 9 years worth of revenue in the pipeline. The question is over how many years that will actually be brought to book. Let's look at the dividend, which of course is always important for shareholders. No chart in the annual report, just this table. But let me just point out to you, we went from 6 cents per share in 2010 and 2011, 7 cents in 2012, 8 cents in 2013, 9 cents in 2014. So it's had that upward curve. And except for the special dividend in 2011, we've really now seen the ordinary dividend rise. And so once again, as a shareholder, when you see ordinary dividend rise, that's not a guarantee that dividends will always be maintained at this level. But companies generally usually only raise their ordinary dividend when they think that they can afford to maintain that dividend into the future. Perhaps a question for the AGM. Let's talk about debts. Maybe if you want to take a look at this table here. And again, the numbers look fairly complicated, but let me just talk you through it. The debt to equity ratio net of cash measures how much debt you have for every dollar's worth of assets or equity. And what we've seen there is that ratio has gone from 0.18 to 0.57. So they've certainly taken on a substantial amount of debt. The net debt to total assets ratio has also moved from 0.13 to 0.32. So once again, debt certainly has increased. In terms of the interest rates and where that debt has been placed, that's also an interesting picture because as you know from reading the newspaper, there's a lot of talk about interest rates set to rise at some stage this year in certain markets. If you turn to page 66 and 67, you'll see in these charts the sources of funding, first of all. And you can see the dark blue and the light blue bar, meaning to say that about half of their debts come from bank loans denominated in Singapore dollars, US dollars, Aussie dollars, Chinese renminbi, and Japanese yen. But flick to the next chart and you can see how much of the interest that they have to pay on those debts is fixed. Very important. As we're seeing interest rates rise, obviously there is the potential to being exposed to those rising interest rates. And CapitaLand's point with this chart is that actually 3/4 of their loans are at a fixed rate. In other words, even if interest rates rise, that's not going to affect them. What's interesting is that elsewhere in the annual report, you can read what interest rates they actually pay on this debt, fixed or not. And they say that the effective interest rate for bank borrowings ranged from 0.51% to 12.5% per annum. I'd like to know which bank is charging them 12.5% in terms of interest rates at a time that interest rates are near zero. Let's move on to the debt maturity profile, which shows you when this debt is actually due. You can see that there is a fair chunk due in the next year or so, around 20%. That should level down as the years go on. Back to the Chairman and Chief Executive's statement on pages 6 and 7, and what we see there is some other commentary on what the future holds. We already know that they have 50 development projects in the pipeline worth $35 billion, but they also give commentary on some of the other parts of the businesses more specifically. When we look at Singapore office, by the way, Capita Green, their latest development at Market Street in Singapore, is one of the only properties to come on stream. In fact, as they point out, the office rents are likely to continue to rise as the central business district supply, new supply that is, will only be available in the second half of 2016. So further office rents set to come in, and as we saw in the earlier chart, rental makes up a not insignificant proportion of their earnings. Now on pages 2 and 3, you will find these particular graphics referring to earnings before interest and tax, 2.4 billion, return on equity, 7.1%. 7.1% is less than the 8% that the chief executive is gunning for. It's an important level because certain parts of the share plan depend on them achieving this level. So we're not quite at 8% yet. That's still the medium-term target. Other commentary in the chairman and chief executive statement, they're expanding their portfolio in selected cities throughout Southeast Asia. Ho Chi Minh City in Vietnam, along with Hanoi, Jakarta in Indonesia, and in Malaysia, they're focusing specifically on Kuala Lumpur and Penang. Also of interest here is this particular statement on growth targets of their integrated developments. That's office space together with retail, for example, where they have one building that houses both. These integrated development projects, there are 12 on the cards throughout Asia, nearly half of them in China. Looking ahead, they are looking to open 3 malls in China during this year: Capita Mall Sky Plus in Guangzhou, Capita Mall Yaoba in Wuhan, and the Tianjin International Trade Center. Ascot, also not to be left behind. Remember, that's one of the 4 strategic business units. Growth will be accelerated, they say, through acquisitions, management contracts, strategic alliances and franchises as they're gunning towards the 80,000 unit target by 2020. Last but not least, some other commentary in this annual report about digitization and modernization. We've seen this in other annual reports too, where companies acknowledge how the change to a digital world is changing their bricks and mortar operations, and CapitaLand is no different. You see on this particular chart, very early on in the annual report, some key statistics here saying that they had 960 million shoppers pass through their doors in Singapore, Malaysia, India, China, and Japan, visiting around 15,000 retail tenants in their various properties. And those 960 million shoppers spent $10.2 billion during the year. Now, CapitaLand acknowledges that there is a big trend towards online shopping. And of course, the question for any shopping center operator, therefore, is how much of that online shopping is going to cannibalize people coming to bricks and mortar stores. So CapitaLand's not blind to that, and what they've said they are doing is investing in their bricks and mortar shopping centers to still make them destinations that people will want to come to. The Westgate playground, for example, an outdoor playground at the new shopping center in the west of Singapore is one such example where they say they aim to make their malls an essential part of the community's social and economic fabric. They go on to say that they're looking to pilot programs to converge digital shopping with physical space and point to their loyalty card as one such project. Also, what I found particularly curious was commentary surrounding how they're making digital tools available to their customers. For example, in Hong Kong, at one of their properties, they're providing guests with complimentary smartphones, together with unlimited 3G data connectivity and free IDD calls, that's international dial calls, to selected countries. Also, they've pointed out that to improve productivity and cleanliness, Ascot is test-bedding the use of cleaning robots in certain properties. You can find out more by going to the annual general meeting. The notice to the AGM is here on page 226 and 227. Read the resolutions before you go along, and here are the details of CapitaLand's annual general meeting.